You're watching SBA Today. With all the latest news, stories, and advice, here are your hosts, Paul Long and Tonya Mazurek.
And good morning and welcome to SBA Today, sponsored by SBA Collective for the week of March 3rd. I am Paul, joined by...
I am Tonya. And Paul, this week we're going to discuss and dive deeper into the February Small Business Economic Bulletin from the Department of Advocacy of the SBA, the economic outlook of franchises, and what industries seem to really be catapulting and changing. But first, Paul, why are we in red? Why are you in red?
Because it was the next thing up in my closet, so I grabbed it.
Such a dude.
That's how I get dressed. I'm a dude.
Today is a blood moon, dude. It's a blood moon.
Oh, so it was like in my brain. It was.
Okay. I did it purposely, and you just kind of showed up this way. Yours is very.
A guy. I have zero error. And other things given. Anyway, well, hey, I know when you're everyone's thinking, oh my gosh, the Small Business Economic Bulletin. Oh my gosh, I need to hold on to my chair. This is going to be so exciting. It actually is. For an SBA lender, you should absolutely be interested in this, and that's why we're going to share it with you today. So, the Small Business Economic Bulletin is the thing for the Department of Advocacy of the SBA. They come out sometimes monthly, sometimes quarterly, with different details about what's going on in the economy. And it's very driven towards what we do on a daily basis. So highly recommend you to listen and be excited. So the first thing I want to talk about is the loan approval rate for small businesses with annual revenues under $5 million. See, I told you, it's right up your ballpark. It's gradually leveled off and is currently lower than rates before the pandemic. Now, so that's interesting. While the number of new applications per bank show a slight increase, it still shows short of pre-pandemic levels. And I don't know if we have the graph shown up for those who are watching on LinkedIn, but the top white line is the approval rate, which you're looking at about anywhere from 50% pre-pandemic to about 48% approval rate. So you're definitely seeing some credit tightening is what this is saying. What is talk to you about this, Tonya? What's this graph telling you?
Well, exactly that. I think there's credit tightening for dang sure. Duh. Yeah. I mean, we've seen in the market. I don't know about you, but I've definitely seen it in the market. I mean, I get so many of my deals from other bankers, right? And they're sending them over because, something doesn't fit in their credit box. And all of us are different, right? One's not better than the other. That's better than the other. We just all have different things that we like or don't like. And I have seen significantly more coming through on deals that ordinarily at that particular bank would have been approved, would have moved forward. And all of a sudden, it isn't. And so I'm seeing those. And I think we're all seeing a little bit of that. How about you?
Yeah, no, 100%. I think you're absolutely seeing that. This chart is also telling us, too, that overall applications are down. And so I mean, frankly, I'm not seeing that because we're seeing a record high in applications. But in general, though, I could see that being the case. Are you seeing high application volume, or what are you seeing in your world?
I think so. I mean, we are really flipping busy. Yes. So I'm assuming I'm taking that to mean, yes, definitely more applications. There's a little bit of competition out there too, though. There's a few that are out there that are just obviously competing amongst each other, which I'm seeing a lot of that as well. So
exactly.
An interesting time frame.
While I was building for this episode, one thing I thought was very interesting is the number one lender is about ready to go over $1 billion already, and it's March.
1
Now keep in
billion.
mind, it's based on the fiscal year, so it's actually,
Right.
6 months, but still, to hit that's pretty amazing. Pretty amazing. So
Pretty amazing. All right. Well, and then the next thing that we're seeing in this is the establishment opening and closings. And basically, in the past few years, the number of establishment location openings with employees, right, has been greater than the number of closings, except for, as you see, if the graph, there's the graph, right?
Yep.
With the graph, there was the spike in 2020, obviously, where closings overtook openings. We all know that was the COVID pandemic sense, inverted relationship there. And then also, though, what's interesting is you see the build up past the fact. So the openings have grown, right? So there's economic recovery since 2020. So it's higher than the closings until check out 2024, second quarter 2024, when it overtakes it again. So that's kind of interesting. Now, twice, 2 blips, and look at how long this graph is. We got from 2005 through 2025. Two inversions for the most part. For the most part, in that time frame. So yeah, I don't know. It's an interesting time frame. What are you seeing?
When I look at like 2024, 2025, I do see closures. Like I don't even need a graph to tell me that. I know there was a lot more closures than starting. But it's good to see that, coming up now that we're seeing more openings than closings. So it was kind of a bleep. I don't know. Everything in this world is totally changing. It could be a signal of good growth. It could be a signal.
I think it could be a signal of economic weakening more so, because
it could, absolutely.
The flip. Yeah. I don't know. Hopefully, let's go back to the optimistic Tonya.
Yes.
It's going to turn around, guys, and the openings are going to outpace closings soon.
And I too am optimistic. I just hope that none of the closures are in my portfolio.
Y'all write down the day, March 3rd, 2026. Yep. Paul just said, I too am hopeful.
I know, it's rare.
No, Paul, come on.
Well,
anyway.
Another report that came out last week was FranData's Franchising Economic Outlook in 2026. And I thought this was very interesting for a couple of reasons we're going to get into. I know we have a lot of individuals who are doing franchise lending. And, what does 2026 look like? Well, good news. It's looking good. It's not looking bad. In 2026, they're looking at the number of franchisee establishments to grow 1.5%. 1.5% isn't that sexy of a number. However, when you're looking at 832,000 units increasing to 845, that's a pretty good impact there. This one, I absolutely was very interested on this one, and I'm sure because Tonya's state's on there and mine's not.
I was going to totally bring that up too, but
were you? Oh, I'm sorry. You can totally do that. You still can.
Totally was.
These are the top 10 states for franchising, and I'm going to start with number 10 and move up to number 1. Number 10, Maryland. That's pretty small. Ohio. Utah, Michigan, Colorado, North Carolina, Arizona. Our top 3 is Georgia. And then the other 2 should not shock anybody. Florida. And the number 1 seed, Texas. So the bottom line is the Southeast region is nearly 30% of all franchises are in the Southeast region of the United States. I thought that was very interesting.
So interesting.
It's fueled by business-friendly policies, lower cost of living, and population growth. I thought that was interesting. So
It's interesting.
I'm sure everyone is moving to those areas. But Michigan, Ohio, and Utah have emerged as new entrants among those top 10 states. So Michigan, Ohio, and Utah, if you are a franchise lender, you should probably be prospecting there. That's where you're seeing a lot more stuff when it comes to franchise. I thought that was interesting.
Wow.
What'd you think?
Interesting too.
Yeah, especially since Colorado's on there.
Well,
and Washington, poor Washington.
I wasn't going to say.
We're not really a
I was like,
business-friendly
where
state.
is Washington, Paul? Are you feeling a little, FOMO?
We are number 49 or 50. I have no idea. I have no idea. That's just my
Don't
opinion.
say that. No, you aren't. You're 48. No, I'm kidding. All right, guys. So that's kind of an interesting one. No, I found that very interesting, actually. But Florida and Texas.
The two states that have the most SBA loans also have the highest franchise. Does anybody? Duh.
Well, and look at how much goes on in those states. Like, I'm doing a few different business broker conventions and different things like that this year. Guess where all of them are, Paul? Florida. All of them.
I don't know what it is about
Florida.
Florida.
Wonder why I might be back in Florida.
The water, it's the alligators, it's Ray Drew. I don't know what it is.
I think it's the
something
down in Key West, man. Those no CMs. I see it. Anyway, okay. Next subject, guys. Okay. The industry outlook. So the industry outlook moving forward is kind of interesting now. I think it's very interesting. So check it out. Ready? See if this surprises anybody. Child services and commercial and residential services are expected to be the fastest growing industries. No, I'm going to throw a little funny in here, guys. Child services. So everybody was locked down during the pandemic. I mean, was there some funny business going on during the pandemic and we got way more babies?
It could be, or it could be all of the child care facilities in Minneapolis. I'm kidding.
You did not. That's worse than where I went. Bleep. Anyway, all right. So child services, commercial and residential services, fastest growing industries. Since the pandemic, rising awareness of preventive health care has propelled the sector to become the third largest franchised industry. I love that.
I would like to know the definition of preemptive health care.
Preventive.
Oh, so if I could read, got it. Me good math.
Preemptive
is
Washington. The same thing. No, if you think about it, preemptive is the same thing because it's preventative.
Yeah.
It's doing something prior to having an issue. So I'm thinking that some of those could be even like the functional medicines or any of those slightly outside.
Okay.
If you think about slightly outside of, those who empower the FDA and all that, anyway,
gotcha. Okay.
I think it's a lot of the others, but I think it's great. Anyway, full service restaurants are expected to outpace quick service restaurants in output growth as consumer preferences are shifting toward experiential dining rather than purely value driven offerings. I mean,
okay, maybe it's just, again, I'm looking at my area around Seattle, but
I think it's kind of
I like the experiential. I can never say that word, so I'm not even going to try. But experiential dining. Ooh, look at me, I can spell. I think that good for dates, good for like things to go out, etc. But I would think quick serve would still be the fastest, but because you need a cheeseburger at 2 a.m. I mean,
it is the fastest. That's why it's quick service, but not the fastest growth.
Well, yeah, but for full service restaurants to outpace.
But here's what I think could be happening, Paul, is think about it, right? During COVID, many became more fast service and they brought that into,
Mm,
think about this for a sec, right? And they brought that in and people
got it.
got really used to it because that's all anybody could really do.
Mm,
Maybe it's coming
okay.
back around and it's really just shifting back to maybe where it was prior.
All right. All right.
That makes sense.
I'll buy that. I'll buy that.
Okay,
Yeah.
good. Hey, finally. In the lodging industry, high-income consumers are continuing to spend on personalized and experiential luxury travel, while value consumers are expected to scale back their spending. So here we go again. Now, those two, the experiential, here's what I love about it, right? I'm all about the experience. I could give two shits, excuse my language, about the cost of it, about things, about material stuff or whatever. I like the experience. Like ask my kids, Christmas comes. I have to make myself actually get them the presents because I want experiences. So like for myself, I'm like, I don't want anything. I don't want a gift unless it's an experience that we can go do together because it's the time, the
Mm,
energy, the memories, the togetherness. And I think maybe people are coming back around. I mean, we're in such a video world right now. We're in such an online interaction that maybe people are looking more for those experiences and that connection.
yeah, that's
When you-
true. Yeah. Um,
Or maybe
I
they just
would,
want
I
to
mean,
meet
again, I'm
together.
just kind of looking at again, myself, our family, we're planning a cruise this summer.
Okay.
The next year we're looking at international travel again. So, I mean, we're looking for that, experience for my two kids. And it's important. And I think you're absolutely right, especially as parents. We want to give our kids an experience and hopefully things that, we didn't have as children. So yeah, no, I think that's very interesting. That's yeah, I love it.
Yeah, well, I just think we're all getting to where some of us are pretty done with the transactional piece, right? And really looking for that
Mm,
piece. Um,
yeah.
I think that's going to keep growing to a degree, but that's just me. Anyway,
Yeah.
I don't know. Anything else, Paul?
That's
What
it.
else you got?
That's it.
That's it.
Yeah.
Okay.
It's
Well,
a
then,
big
guys,
week in SBA.
it's the blood moon. All right. Anyway, so we are live, guys, on Tuesday mornings right here on LinkedIn and or YouTube, or you can watch us at your convenience or listen to us at your convenience on any of the streaming platforms where you get your podcast. Check out our previous episodes and our sister show, the BDO show. If you have questions or comments or just want to, reach out and connect, do that with Paul and I on our personal LinkedIn pages. We would love to hear from you, and we would certainly love to get any kind of ideas or topics you guys would like us to cover potentially on an upcoming show. We recognize there are plenty of places you can be and plenty of things you can be spending your time on. So we appreciate you spending it with us. All right, we'll see you next week.
See you later.